Here we go. Oh, man.
All right, we're good. We're in.
Thank you, Laura.
No problem. Is it possible to open the question back yet?
Let me, if you want to give me a few minutes here. Let me see if I can do it right now.
Okay.
If I can't figure it out,
It's just a point or two, so
you notice that the class might say it's taught by both me and Cornelia.
yes.
I do all the teaching. She does the stuff with campus.
Got it. Okay,
Hey, I got a customer.
thank you.
Okay, we'll get you back so you can
Okay,
answer that question,
great, thank
okay? Oh. Sorry I'm late, guys. We couldn't get into Zoom for a while. Hi, Daniel. Can you hear me?
Hello there. Yes, I can.
Hi, Marlene. Can you hear me, Marlene? Okay, give me a second to bring up the PowerPoints. We had a little computer glitch that prevented me from getting into Zoom, so that's why we're 5 minutes late. Chapter 3, I believe, right? Chapter 3. Share screen. Okay, Daniel, can you verify you can see the screens?
Yeah, I can see them.
Okay. All right, chapter 3. We're going to get into some business transactions now and start the process of accounting. We start by analyzing transactions, and then we record them in a journal, and then we move them into our trial balance and the general ledger. So let's get a look here. Analyze the effect of business transactions on the basic equation. So the accounting information system. We're going to collect, process, and communicate data. And we're going to be following this blue arrow all the way across. Today, we're going to go from analyze business transactions. We're going to go to journalize, which is the act of recording the transaction. That's we actually type it into your system. And then the act of posting it to the general ledger, and then the trial balance. So we're going to go up through this fourth grid here, trial balance. So let's see what it tells us about journals and posting. Transactions are economic events that require recording. Not all activities require transactions. Your boss goes out with a customer and they have a big meeting, but they don't decide on anything. That's not a transaction, except maybe for the lunch that somebody's paying for. You announce a hiring of somebody. That's not a transaction, not an accounting transaction. So transactions are economic events that require recording. Assets, liabilities, or stockholders' equity changes as a result of an economic effect. And it has a dual effect too. You must have two accounts involved minimum in every transaction. That's why they call it double entry accounting. So what events do we record? You purchased a computer, and over on the right you paid rent. Those are clearly transactions. You have to record the purchase of the computer and naturally record the absence of cash and recording the expense. You had a potential customer come in and you had a long conversation with the guy, but nothing was decided, there's no transaction there. Look at your basic accounting equation. I think this is the first time we're looking at it. Assets equal liabilities plus stockholders' equity. Never forget this. Assets equal liabilities plus stockholders' equity. This is the basic accounting equation, and it must remain in balance at all times, and it will. No computer system is going to let you post entries out of balance, I don't believe. That was a problem in the old days when I had to do this in pencil. The accounting equation must always balance dual effect. You're going to affect an asset and a liability, or an asset and an equity, or two assets, etc. If an asset increased, then there's got to be a decrease in another asset or an increase on the liability or equity side. But let's not worry about that. Now, let's look at the expanded accounting equation. The basic equation is the same. Assets equal liabilities plus equity. Assets are things that the company owns that are of value. Cash is a wonderful asset. Accounts receivable, the money that customers owe you at that point in time. Inventory, prepaid insurance policy, supplies, those are all assets. So if you have assets of, say, $1 million and your liabilities are, say, 300,000, your equity is 700,000, okay? So assets equal liabilities plus equity, or assets minus liabilities equal stockholders' equity. Now, what are the components of stockholders' equity? In our book, we're starting off with just two things. We're starting off with common stock and retained earnings, okay? Common stock. You notice that the arrow stops there. Once you issue common stock to the public or preferred stock, that number is never going to change. It's never going to change unless you issue more stock to the public, okay? So the common stock number is a one-time thing. But the other component of stockholders' equity is called retained earnings. Retained earnings is an equity account, Retained earnings is the place where you are going to move your income, your net income, at the end of each year. If you started a business today, you have no retained earnings. You haven't done anything. At the end of the month, you made a profit of $10,000. That $10,000 would flow into retained earnings. The next year, you had a profit of 20. Then retained earnings is going to go up to 30. The next year, you had 30 more. It goes up to 60. You get the idea. So retained earnings is where we run the profit every period through the closing process. If we didn't pay any dividends, retained earnings would equal your profits and losses accumulated from the beginning of the company, okay? Now, where do they get the net income? They get it from the revenues and the expenses. Revenues and expenses. Revenues are your sales, expenses are your offsets to the sales. Now, a company can decide to give dividends out. Dividends come out of retained earnings, So your template's going to be stockholders' equity, and then you have common stock by itself, retained earnings, and the three components of retained earnings are revenues, expenses, dividends. Okay, let's go through, we're going to go through some transactions now. And I'm not going to ask you to set this up on a piece of paper, be a bit much. But let's look at some transactions and let's see how it affects the accounting equation, okay? On October 1st, cash is invested in Sierra Company by investors in exchange for $10,000 of common stock. I guess they sold the stock at par value, okay? So look what's happened here. Cash went up. Cash went up because we issued that amount to the public, 10,000. Cash went up and common stock went up, and our equation is still in balance. Assets equal liabilities plus equity. The next transaction, Sierra borrowed $5,000 and they signed a 3-month 12% note. That means that they're going to have to pay 12% interest annualized for this note. That's a note payable. So what's going to happen? Cash is going to go up 5,000. Cash goes up 5,000. So does this liability. Cash went up, and now we owe $5,000 to this lender. Next transaction, Sierra purchased equipment for cash. Equipment for cash. So I would expect to see equipment go up 5,000 and cash go up another 5,000. Or down, of course, rather. I meant to say down. We bought the equipment, right? Sierra received a $1,200 advance from Knox. This is called unearned revenue, which is a liability, and we'll talk a little bit about this today. So he received cash. You're going to see 1,200 here and 1,200 here under unearned revenue. And what unearned revenue is, it's monies that were received in advance of doing anything. In other words, I'm a big sports fan. I buy season tickets from the Dodgers, say. I send them $12,000 in February for the upcoming season. When they get my money, they're going to increase cash and increase this liability account called unearned revenue. They cannot call it revenue until they do what? Until they play some baseball. Okay? So that's monies you get in advance for which you haven't done anything. Sierra received $10,000 in cash for some guide services. That sounds like revenue to me. Here we go. Cash goes up, revenues go up. Stop me if you think I'm going too fast, or you have a question or something doesn't seem clear. Sierra paid its rent expense. We're going to see rent go up 900, the cash go down, and we're going to itemize it off to the right. Rent expense. Okay. Cash goes down, rent expense went up. Sierra bought an insurance policy 1 year. It's for the upcoming year. It's for the coming year. So that is an asset. Whenever you buy an insurance policy, it is an asset. It is not an expense until you actually get the coverage. So what's happened here? They purchased an estimate. They bought it on account. I'm sorry. Yeah, they paid cash for it. Sierra paid $600 cash for 1 year insurance policy. And there it is there. You have a new asset and you lose another asset. But just an exchange of an asset. Just like on line 3, that was an exchange of an asset. We exchanged cash for equipment. Let's see what they did here. Then they bought 3 months of supplies on account. Whenever you see the words on account, please say to yourself, on account and nobody had money, okay? When you see on account, there will be no cash involved in the transaction. The cash is, in this case, is going to be paid later. So when you see on account, you know it's not going to be cash. It's going to be accounts receivable or accounts payable, depending what side of the ox you're goring, okay? So here we purchased 3 months of supplies. That's an asset. So supplies are going to go up $2,500, and accounts payable went up. Accounts payable. Sierra hired 4 new employees. They're going to start work October 15th. Well, that doesn't mean anything. That's not a transaction. So line 9 would be blank. Now they paid a $500 dividend. Remember that dividends come out of retained earnings, if you remember that. So let's see here. $500 dividend minus cash, and then it's a minus here for the dividend. A dividend reduces your equity. You're giving away part of the company. And then finally, we have employees who worked a couple of weeks, they earned $4,000. Well, and it was paid on the 26th. So we're going to see an expense on the right side here for salaries and wages. Oh, they don't give us that one. You have to take my word for it. The expense went up 4,000 and the cash went down 4,000. All right. That's a poor man's look at some transactions. Just getting you familiar with the accounting equation, how it must always be in balance. Okay. Assets equal liabilities plus stockholders' equity. And then equity has these 4 components: common stock, revenue minus expenses, dividends. Revenues minus expenses, what does that equal? That equals your net income. So you can say retained earnings has common stock, net income or loss, and dividends. A tabular analysis shows they're showing some stuff here. Company issued shares of stock for 25,000. Okay, so let's look at this together. They're giving us the answers already. Company issued shares of stock for 25,000. Well, they received 25,000 in cash, and that's what the company is worth on that particular day. They just have the 25 large. Company purchased $7,000 of equipment on account, and nobody had money. So equipment goes up, but so does the payable, the liability. Whenever you see the word payable, you know it's a liability, it's a debt, it's an IOU. The company received 8,000 cash for services performed. They did some work finally. They brought in income, revenue, if you will, sales of 8,000, and cash went up, and then they had to pay the rent. So the rent went up, which is the same thing as minusing retained earnings, and the cash went down. Okay. That takes us, I think, through the first grid. Now it gets tougher when we get into debits and credits. No more of this up and down, more or less, increase, decrease, add, subtract. We're going to start using the accounting language of we're debiting an account or we're crediting it. So you're going to have to learn your debits and credits as quickly as you can. They can be a little tricky at first, even though there's only 5 things to remember. But it'll be a little tricky. But once you master them, you'll be good. It's like learning to drive a car. It might seem so hard at first, but once you learn how to drive it, you're fine. And that's what we have here. We got to learn to drive this car. Debit and credit procedures. Each transaction must affect 2 or more accounts to keep the equation in balance. So keep that in mind. You must have 1 debit and 1 credit, or 1 debit and 100 credits, or 1 credit and a whole bunch of debits. As long as the debits equal the credits, the debits must equal the credits. If the debits are greater than credits, that's the balance. It's a debit balance. So let's look at our general ledger here. Apparently we had no beginning balance. And then let's pretend this is cash. We brought in $10,000 in cash on the first of the month, say. And then on the second day, we spent $3,000. And then on the third day, we received another 8,000. 10 plus 8 is 18, minus 3 is 15. Okay. That's how you foot a T account. If credits are greater than debits, then it has a credit balance. Okay, so this could have been notes payable. Maybe we borrowed money, 3,000, then we borrowed another 8,000, and then we paid down 10. That leaves the balance of $1,000. This is a T account. This is your general ledger. The general ledger is a glorified pair of T accounts. Okay, here's where it gets a little tricky, huh? Asset accounts. Assets have a normal debit balance. Can you remember that? Assets have a normal debit balance. And assets should always have a debit balance. Assets are debits. Liabilities always have a credit balance. So note the difference here. When you want to increase an asset, you debit it. When you want to increase a liability, you credit it. Normal balance. The normal balance of an account is the side of the T account, debit or credit, where we expect to increase. You increase it on the normal balance side, okay? The normal balance is the side where increases are recorded. Now we have a couple more rules. Assets have a debit balance normally, which means always. Liabilities, you just learned, have a credit balance. So does stockholders' equity. Stockholders' equity, by definition, has a credit balance. If you ever ran into a debit balance on stockholders' equity, and you could, that means that the company's basically out of business. They don't have any value. So what are the components again of stockholders' equity? Remember, common stock, which is part of equity, it has a normal credit balance. Retained earnings, hopefully, has a credit normal balance. We increase. And dividends have a normal debit balance. When we debit a dividend, we are decreasing stockholders' equity. Those are all the rules that you have to memorize. Not just memorize them, but do enough exercises where it's like the back of your hand, where you don't even hesitate. If I said to you now, cash, do we debit or credit it to increase it? You might hesitate for a second and say, I think Bob said debit. You got to get to the point where you just whiz through it. And here they're showing you the same thing as over here. Let's talk about the effect on the accounting equation, your T accounts. Revenue increases stockholders' equity. A revenue is sales. Sales, income, revenues, whatever you want to call it, increases stockholders' equity. Expenses decrease stockholders' equity. Revenues have a normal credit balance. Credit balance. Expenses have a debit balance. And there's no other way to teach it, just telling you just to drill on it until you're familiar with it. Why they bring the Chicago Cubs into this, I don't know. Let's look at the financial statements, some relationships, huh? At the end of the month, we're going to prepare an income statement, a statement of retained earnings, and a balance sheet. These are basic templates. Your income statement is simply revenues minus expenses. That's all you see on an income statement, revenues and expenses. You don't see assets. You don't see liabilities. You don't see equity. You just see revenues and expenses. This company here will assume had a profit of, we'll say $1,000. We do the income statement first, and you do have to do it first. These must be done in the proper order. Now that we have the income number, we can up update retained earnings. Remember we said that we bring the net income every month into retained earnings? Here's where we do it. We take it from the income statement, $1,000, and we increase retained earnings with this $1,000, and we will reduce retained earnings if they gave out any dividends. That in turn will give us the ending retained earnings. Ending retained earnings. Beginning retained earnings, the retained earnings on January 1st, plus the January net income, minus any dividends paid during the month of January, gives us the January 31st retained earnings. And when we get those numbers, we can bring them up to the equity section. We bring the retained earnings up to the equity section, and we've updated, okay? Here's a grid. Here are the 5 things you got to memorize. This is it. 5 things: assets, expenses, and dividends have normal debit balances. Assets, dividends, expenses. Assets, dividend, expenses. Debit balance, it means you increase the account with a debit. Liabilities and revenues have credit normal balances. You increase the number with a credit. So this grid right here, grid number 33, I guess it is. This here gives you everything you need to know. You might like this better. I don't particularly do. I think this makes more sense. But they're showing the same thing over here. Assets, debit balance, expenses, a debit balance. Liabilities, equity, and revenue, they have a credit balance because they're increased. They're increased with a credit. The world of debits and credits. And here's another one where they're trying to teach it to you. Assets equals liability plus stockholders' equity. And stockholders' equity is where we're going to find the common stock, the retained earnings, and the net income in the form of the total revenues minus the total expenses, and then dividends. So looking at it again, assets have a normal debit balance, liabilities have a credit balance, so does common stock, retained earnings, and revenues. The other 2 are debits. And debits must equal credits at all times. Debits increase assets and decrease liabilities. Debits, look here, a debit increases an asset, but it reduces a liability. So I think the answer is C. Okay, and there should be a lot of questions like this on your homework, and there'll certainly be on the exam a ton of questions along these lines. Accounts that normally have debit balances. Debit balances. Assets and expenses, yeah, but not revenues. Assets and expenses, yeah, but not equity. Assets and dividends, yeah, not liabilities. It's the last one. Assets, dividends, and expenses. Now we're going to talk about using a journal entry. This is how we move the numbers into our general ledger. And remember, we started off with that long pair of arrows. Now we're getting into the second part, journalizing the transaction. We did the analysis already. We analyze each transaction in terms of its effect on the accounts, and then we enter that information into a journal. General journal, it might be called, or journal entries. You're going to go into your system and get up the grid for the journal entries, and you're going to have information in front of you, and you're going to enter the debits and credits and an explanation probably, and then go from there. Afterwards, we're going to post the information to the general ledger. But right now, we're just recording it. Take a look at what a journal entry looks like. This is a journal entry here. They're kind of hiding it on us though. We analyze. This is the journal entry. You enter the transaction and then you hit a button named post to bring it into the ledger. This is not a clear screen. So let me give us something. We'll find something that's better suited. Transactions are recorded chronologically in your journal before they're transferred to the accounts or the general ledger. The journal contributes to the recording process because it gives you the complete effect of a transaction. It's a chronological record, and it helps to prevent or locate errors because the debit and credit amounts can be easily compared. Journalizing, that's the act of entering the transactions. So these transactions here are similar to the ones we did before we heard about debits and credits. So Sierra issued common stock in exchange for cash. Well, let's see what happened here. We issued common stock. That means our cash is going to go up, and so is common stock. So I would expect we're going to debit cash, and credit common stock. So take a look at what the journal entry looks like. It's got a column for your debit and credit, a longer column where you can put the account name in and type in an explanation, which should be there, and then the date. That's your grid. We debit cash, we credit common stock. They both went up. They borrowed money by signing a note. Cash is going to be debited. Notes payable is going to be credited because liabilities have a normal credit balance. Right there. And then in the last one, they purchased equipment for $5,000. I assume that's cash. So cash is going to be credited and the other asset is going to be debited, equipment. Okay. Making some sense, Daniel, as we go along here?
Yeah, slowly but surely.
Okay. And then they're showing you some of the other journal entries. Well, I guess these are the three we just did. Okay. And that's exactly what your screen is going to look like. You're going to type in cash, or probably not type it in, but you know, hit on the button that says cash. Come, select them from a menu. Okay. The following events occurred during the first month of business of Here It Is Incorporated, Kate Brown's Beauty Salon. Issued common stock to shareholders. Purchased equipment on account to be paid in 30 days. Interviewed 3 people for the position of stylist. How do we record that common stock? We're going to debit cash for 20,000. That increases the debit, rather the asset, and we credit common stock for 20. Then we purchased equipment on account. So the asset goes up, so does the liability go up with a credit. When you see on account, you know there's no cash involved. It's going to be accounts receivable or accounts payable. Just make sure you understand if we're doing the buying and thus have to pay, or we're doing the selling and we'll collect. And they interviewed 3 people for a job. No entry there. Your human resources department, I'm sure, has the resumes and the applications and all the educational backgrounds that they want filed away, but it's nothing to do with accounting, not yet. Explain how a ledger and posting help in the recording process. Okay, we started off with the first red piece here, analyze business transactions. Then we learned about debits and credits and writing the journal entry. These are journal entries here. You debit and you credit. Let me point out something I forgot. You notice, Daniel, that the credit is indented. That's very important. You always indent a little bit for the items that are credits. That's the way auditors expect to see it, and it shows you know what you're doing if you do that. So we analyzed the transactions to begin. We learned the journal entries. Now we post to the ledger, to the general ledger. The ledger, that's the books of the company. I want to see the books. He's cooking the books. Let's check the book. This is the general ledger. This is the accounting Bible for the company. Think of the ledger as a bunch of folders. Think of it as a bunch of folders. And that folder is going to have two T accounts, one for the transaction and one for the running balance. So under asset accounts, this company has cash, supplies, land, equipment. It's got accounts payable, notes payable, wages payable, interest payable, and it's got some of the equity accounts, equity, expense, revenue, dividends, and common stock. This is what's called the chart of accounts. The chart of accounts. This is the list of folders that this company chose to generate a folder for. Certainly, you want to have one for cash, accounts receivable, supplies, insurance, equipment. They seem reasonable. Liabilities, you have notes payable, accounts payable, the unearned revenue. Stockholders' equity, we've got the common stock. We got retained earnings and dividends, revenues, and then the expenses, okay? I'm only reading the red ones because those are the ones we're touching in this chapter here. So here we go. Here is our journal entry, okay, Daniel? You're at your office and you're saying, all right, first day of our new company, we just issued $10,000 worth of stock to the public. Hooray, we got $10,000 in cash. We're going to write a journal entry. We debit cash for 10 and we indent and we credit common stock for 10,000 and we show a little explanation. That explanation should be very, very short and sweet. You can always start it with the words "to record." I would have written that to record stock issue. That's all you need to put down there, okay? Now, we wrote the journal entry, and then we closed out the journals. At that point, we haven't done anything to the general ledger. We have to perform a second step called posting. And what's going to happen is, let's assume this is the only journal entry you wrote on this particular day. At the end of the day, you say, okay, I'm not going to write any more journal entries today. I'm going to post. And you hit a button called post, and all this information ends up in your general ledger. Here's your general ledger. Cash now has a balance of 10,000 from the debit, and common stock has 10,000 from the credit. They both went up, okay? Posting, that's what you do maybe at the end of the day when you finally finished your journal entries. Posting normally occurs before journalizing. No. Transfers ledger to the journal. No, it's the opposite. It's D. Transfers journal entries to the ledger accounts, okay? Steps in recording. Determine what type of account is involved, what increases or decreases, and by how much. And then translate the increases and decreases into debits and credits. Debits and credits. Debit and credit. Debit means left, credit means right. That's all they mean, left and right. One is not better than the other. There are no value judgment here. And now they're going to take us through a few of the transactions, okay? Here is the one we were just looking at, okay? Here's how we did it earlier today, Daniel. we said that the accounting equation, assets equals liability plus equity. There we go, 10, we're in balance. Now we understand debits and credits. We know we're gonna debit cash and we're gonna credit common stock. Okay? We did that, and then we decided to post our journal entries one by one. Then we hit the post button and it transfers these numbers into the general ledger. This is where your auditors are going to start working. They're going to come in at the end of the year, and the first thing you're going to say is, how much cash do you have right now? And you show them $10,000 from here, and they're going to go through all kinds of tests to verify that. Event 2, you borrowed cash, $5,000 against a note. $5,000, huh? Well, our cash went up. It now has a balance of 15, and notes payable goes up with the credit, 5,000. They bought equipment using cash. So now the cash has gone down with the credit. Equipment goes up with the debit. And also always start with the debits first. For the most part, whenever you can, start with debits first. If it's a 2-line journal entry, certainly you do the debit first. That's a convention. That's what auditors are looking to see. Makes their jobs a lot easier. Let's see. Sierra received a $1,200 cash advance, huh? The asset account cash went up, but so did the liability account. The liability unearned revenue is increased because the service has not been done yet. That is, when an advance payment is received, unearned revenue should be recorded to record the obligation that exists, okay? And you can see the cash is going up here. We did some services. We took people on a nature hike. And we did it, and we received $10,000 in cash. Cash went up, so did revenues, which means we debit cash and we credit revenues. Paid the office rent, paid it. So we're recording rent expense. That expense needs to be recorded. So that goes up with a debit, and cash goes down with a credit, okay? We bought an insurance policy for $600. By definition, when you buy an insurance policy, it is an asset because it's the future that you get the benefit of it. You don't get in an automobile accident and then buy insurance and they're going to cover you. It doesn't work that way. Insurance, by definition, is going to benefit you in the future. So till then, it's an asset. We're going to debit the asset called prepaid insurance, credit the one called cash. We're going to hit our post button. And when we hit the post button, the $600 debit prepaid insurance is here, and the credit to cash is over here. We bought supplies. We bought an estimated 3 months worth of supplies. Well, supplies will eventually be an expense, but only when you use the supplies. When you buy supplies in advance like this, that's an asset. We're going to call that supplies. It should be called prepaid supplies. We're going to call it supplies. The word supplies means an asset. So that asset gets debited for $2,500. And since we're going to pay it later, it was on account, no cash, we're going to credit accounts payable. On October 9th, Sierra hired 4 people to begin work. Each employee is going to make $500 a week. Well, there's nothing here for accounting to do. Maybe human resources is busy, huh? Maybe the maintenance department getting an office set up, but not accounting. Hey, they paid $5,000 in dividends, right? So we are going to debit dividends, and dividends are a part of stockholders' equity. So by debiting dividends, we're reducing the net worth of the company by $500 and we credit the cash. Credit the cash. Sierra paid some salaries, $4,000. We debit the expense because expenses have a normal debit balance, and we credit the cash to reduce the cash because cash also has a normal debit balance. And then here, they're just listing the transactions that we just did, I think. Okay. Here, let's pretend we haven't posted anything. So you've been working all day, you've been in a meeting, and when you came back from the meeting, you wrote these 2 journal entries, and then you went to lunch and you came back and you found out you had to do a few more. And then you had to do something down with the engineers and the purchasing department. They needed somebody from accounting. Came back from that, and then you wrote the rest of these journal entries. At that point, you posted it. Then you posted it. And this is what it's going to look like. Here is your general ledger and the balances. Cash. How do we get this number? 15,200 debit balance. Supplies, 2,500. Notice that all of the assets have a debit balance. The liabilities have a credit balance. So does common stock and revenues. Dividends and expenses have a debit balance. So here we are. And we know that these debits equal the credits. We know they do. How do we get this 15,200? We add the debit side, we add the credit side and subtract them, and the high man wins. What if the month end came and you added the numbers up and you had a credit balance? Suppose that was a credit of 15,200. Well, that could mean a couple things. It could mean hopefully somebody just made a mistake, an easily correctable mistake. They hit the wrong account and you can fix it real easily. Or somebody's playing the float the check game, which can get you in trouble, where you're writing checks on accounts that don't have any money in the hopes of recouing money in the mail the next day or two. That's always risky. Or the worst of all worlds, somebody has stolen money. So there's your general ledger. And we're going to use this general ledger to prepare the financial statements. Okay, they're just asking us to post these to T accounts. Well, that's easy enough. Post them. Oh man, they took the wind out of our sails. Let's do it together here, everybody. We have a debit to cash for 30, so the 30,000 would end up there. The credit to common stock would go there. We have a debit to accounts receivable, a credit to service revenue, and we have another debit to cash and a credit to accounts receivable. So it's not too hard. Prepare a trial balance. Trial balance. And this is as far as we're gonna go today. We're gonna get into this and be done. A trial balance. It's just a list of all of the accounts and the balances. The accounts are listed in the order they appear in your chart of accounts or your general ledger. They're in order: assets, liabilities, equity, revenues, expenses. Assets, liabilities, equity, revenues, expenses. And the only thing the trial balance does for it is prove that debits equal credits. And it might uncover some errors if something looks goofy. But the main thing is, once you're happy with the trial balance, now you can use it to prepare the financial statements. So let's see where they take us. So look at the trial balance. Cash balance of 15,200. You remember that? Supplies 2,500. 600, 5,000. Where did we get those numbers? We got them right from here. Here's your 15,200, 25, 605. Here's your service revenue, 10,000. 2 expenses, 4,900. So we got them right from the general ledger. Now, a trial balance may balance even if a transaction is not journalized, or something is not posted, or you posted something twice, or you posted it wrong. In other words, the trial balance could be 100% wrong. The only thing it's doing for us is telling us that the debits equal credits. But there is a process to go through to verify the balances in the trial balance. And that's what we'll be getting into when we get to chapter 4. Do it. Trial balance. Prepare a trial balance in good form. In good form. Remember, we said the assets go first. So what are your assets here? Equipment, accounts receivable, prepaid insurance, and cash. Something is to be cash, accounts receivable, prepaid insurance, and equipment. Cash, accounts receivable, prepaid insurance, and equipment. Just look at this. Notice it's in order of assets, liabilities, equity, and revenues and expenses. So this trial balance is balanced. Now we can do our financial statements, but we're not going to do it in this chapter. Let me just do something. Yeah, we're not going into IFRS. Hey, Daniel, that brings us to the end, okay, pal?
Alrighty.
Any questions, any comments?
No questions. I think I just need to go practice it a bit.
Yeah, just become an expert with the debits and credits, okay?
Okay.
All right, we'll see you later, man. Bye-bye.
Thank you much. Bye.
You're welcome.